Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and quite excited today because we had some great earnings out from Fortuna Mining this morning, and joining me to go through those are, of course, the CEO of Fortuna Mining, Jorge Ganoza, and my dear friend Dave Kranzler, who is joining us from the analyst side. And quite a quarter it was, so there will be plenty to dig through. One note before we get started, because I know this just came out, and for anyone who has not seen it, the Federal Reserve did just cut their interest rates by a quarter point. So in case anyone was wondering about that, I'm sure you'll be hearing plenty more about that later. Although with that said, let us get to the main portion of our show, which again, as I just mentioned, is record third quarter for Fortuna. They came in at a record attributable earnings of 50.5 million. Also, record operating cash flow before working capital. And Jorge, again, as we've talked about on some of these previous calls, you made some big steps and moves for the company back in 2021, went out, built the mine, and now it is operating, and you just had a great quarter. So perhaps if you could give your thoughts and share anything from the third quarter there.
In the third quarter, Marcus, we continue delivering on our value proposition to our shareholders. We had another consistent quarter where we are capturing the benefit of higher prices by controlling cost and controlling our capital spends. And it's showing in the margins. We're showing expanding margins. If I look at it, for example, from the EBITDA perspective, just one point of reference, we run the business with an EBITDA margin of 48% in the third quarter. If I compare that to the second quarter, our EBITDA margin was 43%. And in the first quarter, our EBITDA margin was 41%, right? So we've been showing expanding margins as we capture the rising prices, no? Our production was largely in line with guidance, or costs largely in line with guidance. We have a portfolio of 5 operating mines. So, of course, within that, we'll have some gains and losses in terms of our cost performance. But all in all, our costs were basically in line. And on the capital spend, as you know, this is a very capital-intensive business. We're spending this year about $130 million at our mines, no, under the concept of sustaining capital. We're 75% complete with the execution of all of that capital, about $98 million for the 9 months, and largely within our expectations and plans. So, it's showing in the numbers, right? We had a strong quarter where we beat the street estimates on earnings per share. The street was expecting, the consensus from analysts was around 11 cents. We came in at 16 cents, or consensus for cash flow from operations was around 32 cents. We came in at 38, 39 cents. So we beat the estimates, generated strong revenue, and supporting strong margins. Free cash flow from ongoing operations came in at a strong $56 million compared to $38 million the previous quarter. So, expanding margins and therefore expanding free cash flow, right?
Yes, and along those lines, something that I found particularly interesting in the release this morning, mentioned here, realized gold price was $24.90. And also up here, we see production came in at just under 111,000 ounces, bringing us up to 339, and still in line to meet 457, which, if that's the case, would mean we'd be looking at higher production in the fourth quarter than the third quarter. And well, again, I know you're not able to guarantee us the gold price. Here you can see July to September. And as we can see here, clearly the gold price, at least for the first half of the fourth quarter, is a bit higher. And Jorge, I guess the question in there is just, is there anything else that we would want to watch out for? Or are those parameters I laid out sound about right, and could be even a further margin seen in the fourth quarter?
Yes, and I think as a whole, if we step back a bit, the challenge and demand from our investors is in this rising price environment that we keep a lid, a cap on our cost, and be prudent with the management of capital projects, right? Which are, as we discussed, mentioned earlier, this is a capital intensive business, right? And again, we're investing this year on the assets around $130 million, right? Exclusive of exploration, right? I believe the demand from investors is show me the expanding margins, and we can only do that if we keep disciplined with cost and execution of those large capital projects throughout the portfolio. And this is not particular to Fortuna. It is for the general mining sector, right? I think that's a demand. So something to watch for, I think that was your question, is disciplined cost management, disciplined capital execution, right?
Yes, and speaking of cost, that was the next thing I wanted to pull up here, because we see cash cost came in at $1,059, $4 above the annual guidance range, although adjusting for San Jose, which now is set for closure, and we'll come back to that later. But adjusting for that, is that the cost is at 935, and similarly with all-in sustaining costs, we came in at 1696, which is a little bit above the upper end of the guidance range. Although the key thing, or I guess two key parts, A, if you could talk about how this San Jose closure will affect the cost structures. And of course, I think you knew I was going to ask again about the Lindera leach pad, which now very close to completion, and where that would leave us going into 2025.
Yes, at a higher level, where do we want to be with respect to cost, right? And strategically, we want to be positioned in the middle of the pack or better. That means today the global gold mining industry is producing gold at an average all-in sustaining cost that I believe is around $1,500 per ounce, or perhaps a bit higher, right? I believe that's probably where the average sits today. I watch closely the figures that the World Gold Council produces. They do track cost across the sector, and they publish those figures quarterly. So I believe the number currently hovers around 1,500. So I want to have my AISC at or below $1,500. No, that means that under a price correction, you would have to wipe out half of global gold mine production before it gets to me. No, to put it in simple terms. So strategically, that's where we want to be. So where are we trending? As you just mentioned, we are losing production at San Jose this year, which is our highest cost mine, and we're completing a very heavy capital project in Argentina, which is a decade, a project that serves the mine for a decade, and we're executing it this year. So if I adjust for those two projects, which are not in the portfolio in 2025, we're seeing at least 150, close to $200 perhaps, coming out of my AISC, right? So I feel comfortable that we are trending in the right direction. So looking at cost, my costs seem, we're very much aligned with our guidance. We're not seeing pressures against what we budgeted for the year. And on capital, even though $100 is above the average, throughout the years, investments move up and down. But if I normalize it, I think I'm comfortable that Fortuna is where it needs to be.
Well, that certainly is good news, a higher gold price and costs coming down. And perhaps with that said, Dave, I I know that makes you happy on the analyst side, and why don't you take it from there with any questions you have?
I do have a couple of questions. I just wanted to kind of circle back to the level of profitability that you achieved in the quarter. So, just looking at the profit margin at the mine level on a consolidated basis, your operating profit was 31.6% in Q3 versus 30.7% in Q2. Can you just kind of specifically talk about the types of things you're doing in order to achieve that?
Yes, again, with 5 mines in the portfolio, we have different things moving. Performance on the side of cost has been driven by the West African operations, Yaramoko and Séguéla, which are performing very well against cost guidance. Where on the LATAM side, Lindero is operating at a bit of a higher cost, close to 10% higher cost on a per ounce basis. And that's driven by a lag in currency devaluation against inflation. No? It's just a macroeconomic factor of a country that still has a distortion in the economy. On the Caylloma side, our cost is higher as a function of Caylloma has a big component of base metals, and with gold price rising, silver price rising, those equivalencies, those relative prices between gold and silver become out of whack, right? So on a cost per ton, Caylloma is trending very well. On a cost per ounce, as we do equivalencies with base metals, at that one mine, the cost on a per ounce basis seems higher, but on a per ton basis is in line. And then San Jose, which really is struggling with performance, it's down between 15 and 20% with respect to metal output this year. And it's the last year of formal mining operations. And that's driving, even though on a cost per ton basis, they're meeting their budget in terms of dollars per ton, and that's what we mine, tonnage. As those tons come with less ounces on a per ounce basis, they're missing cost guidance, right? So all in all, the budget nets out, and we are trending in the middle of the guidance range, right? But performance is being driven by the larger mines in West Africa.
Okay. Another thing that raised my eyebrows was you achieved an optimization at Séguéla, 35% higher throughput than rated capacity, and I think it also said 20% higher than the throughput that is in the 2026 mine plan. And it doesn't take a lot of capex to do that, so it's almost the added output, almost dollar for dollar, is going to flow through to the operating profit level. How the heck are you guys doing that?
Yes, this is a mine that has been it's a bit over a year since it started production, and every time you design, you build in the design risk factors and opportunities and this in different aspects of the design. No? For example, to help understand this, we designed the comminution circuit, the crushing grinding circuits, with an estimation of the type of rock that we're going to send through that, right? We're going to send millions of tons over the years. So the hardness of that rock is estimated. And then we produce an estimate on the hardness of the rock. And again, the deposit is wide, big, and varied. So we make averages and whatnot. And based on the estimation of hardness, we design, and then we give ourselves a safety factor, right? Because estimation of that design parameter can be tricky. So we provide for safety factors. And we do that in every aspect of the design, on the thickeners, on the cyanide tanks, cyanidation tanks, and everything. And then we build, and then you start capturing some of those opportunities. And it's not always that you can capture all. Usually you can capture some of the opportunities in portions of the design, but then you run into bottlenecks because, for example, if you can capture the opportunities in the design to manage higher fluid flow in the liquid humid part of the circuit, like thickeners and cyanidation tanks, just as an example, but not in the SAG mill, you have a bottleneck, right? And you cannot capture all of the opportunities because you run into a bottleneck. And those are the debottlenecking exercises we do. In this case, we've been able to capture all of the opportunities in the design, right? And that's rare. And that's why with minimal investment, since the delivery of the construction and commissioning, we've been able to expand production in a sustained manner as we balance the circuits and we get more, we fine-tune, the team fine-tunes every month a bit more of the process, right? There are some adjustments that are made, minor, but without any major capital project, like adding more tanks or putting another ball mill or whatever, we've been able to capture all of those opportunities that's yielding that. The benefit of that is millions of dollars, measured in tens of millions of dollars.
So I just have a couple more. Sorry. On the earnings call, you mentioned that you increased your drilling budget at Kingfisher. So A, does that mean you're getting a lot more optimistic about what's probably there? And B, I know you mentioned you're going to put out a updated resource estimate for the company by year end. Will you be releasing an MRE for Kingfisher in conjunction with that or before that?
We're gonna, to start from the end of the question, looking to publish an updated resource for Séguéla more than Kingfisher, right? For Séguéla, because at Séguéla we've been talking a lot about Kingfisher, but we have other initiatives ongoing, right? So the update is going to be for Séguéla.
Okay.
Yes, we are very excited about Kingfisher, and the fact that we increased drilling speaks to how excited we are about the opportunity, and that it requires more drilling, of course, right? So that's why we expanded. And the expanded budget is not solely allocated to Kingfisher. We have also allocated a portion of those funds to Sunbird, where we continue having success with our drilling on the deeper parts, no? Where we're building the case for an underground mine at Séguéla.
So, and just one more, can you kind of update us on what's going on with Diamba Sud? And have you established a timeline to release an MRE for Diamba Sud?
At Diamba Sud, several things going on at the same time, right? We stopped drilling because of the rainy season.
Mm.
Drilling is just restarting now in this month of November. We had a wetter rainy season, so it's only now that we are able to hit the ground back again. At the same time, we're working on the engineering studies for the updated PEA. Of course, this updated resource informs that PEA, right? And concurrent with all of that, on a parallel track, we continue with our environmental studies, biodiversity, and all of that good work. We will meet in early, so we plan to publish a resource estimation before end of the year for Diamba, and then we will meet during Q1 to assess the near future or the decisions we have to make with respect to how the AMBA continues advancing. That means, do we go back to do more drilling? Do we treat it as a development project? No, but we need to see the PEA numbers, the updated resource, and make that decision if it continues advancing as a development project, or we need to go back and drill more. Right? That depends a lot on all the information we'll be generating over the coming weeks, really, right? Couple months.
Okay. And just one more quick question. Let's just assume everything goes well, right? It meets your optimistic expectations. What do you think would be the timing on when you would start construction of a mine?
Let's say if we meet in February and the resource and the work on the capital project to build that mine is supportive of high returns on investment, we will immediately start moving in the direction of a definitive feasibility study, which I believe we can have complete by end of the year. So around end of the year, a construction decision, a proper construction decision could be made. So that will take us until 2027, late 2026, right? For production, for first gold.
Right.
It's assuming everything goes smoothly, right?
Right.
So PA, again, a perfect timeline. PA successful in February, March. Give it 5 months. They'll take you to August, September for a definitive study with that allow us to make a public construction decision, right? That'll be September, October 2025. And then, 18 months of construction, right? Puts you sometime in 2027, early 2027, late 2026. Yeah.
That's great. That's all I've got.
All right. Well, thank you, Dave. Actually asked a couple of the next few questions on my list, and hopefully I'll see you in Diamba's suit in 27 or 28 for see you holding the gold bar there again. Jorge, go ahead.
I hope I'm invited.
You enjoyed that one, huh? You enjoyed holding that bar.
Oh, it was awesome.
I'll get that picture pulled back up before we wrap up here.
Let's not.
No, you look sharp wearing gold, Dave. You do. So, Jorge, a couple other Sequela questions, if I may. The first one, the throughput rate, 35% above the nameplate capacity. Is that what you're expecting to do going into next year and throughout next year as well, or?
We're completing our budgets as we speak, and the design, the budgeting rate, the rate we're using for the planning hovers around that 35% line above design capacity. Is about 205, 208 dry metric tons per hour in the system. There are times where we have peaked at around as high as 230 tons per hour, but it has been difficult to sustain, right? So perhaps as we can continue working on the little things, perhaps some more automation on parts of the system, addressing certain aspects of that, we can get it higher. I think there's still opportunity, but yes, we're designing with 205 dry metric tons per hour. Something important also to mention with respect to both the mines in West Africa is first with Séguéla. In the news release, in the MD&A, we're providing some guidance to additional capex that we're going to start putting into the mine. Because we're talking about, and we're all happy because we have expanded throughput. But expanded throughput means two things. One, you're consuming your deposit at a higher speed, no, at a higher rate. And second, the infrastructure that you planned initially, you are making use of it faster. For example, a tailings dam. No, we need to expand our tailings dam sooner. Land compensation and access to other deposits that in the original plan were further out in time. We have to accelerate all of that. So, we have capital projects that are going to come next year thanks to the acceleration of throughput, right? There is no free lunch, right? There is no free lunch here. So we're all excited about the higher throughput. Well, that means we need to accelerate capital projects in order to support that higher throughput rate, right? There is, of course, always a positive benefit. And as we put out in the news release, with all of these capital investments, we expect to unlock in our life of mines opportunities to produce between 140 and 200,000 ounces of gold annually, right? So, the increase in exploration expenditures is tied to the fact that we're consuming the deposit at a higher rate. So we need to increase also the spend in exploration. The expansion of the tailings facility, a project that was originally scheduled for 2027, 2026, we need to bring into 2025. Access to Badior, Sandbird, and other deposits that were, out in time, we need to bring them closer. We're mining at a 35% higher throughput rate with opportunities, as we discussed, to do it faster. So we need to deal with depletion faster, and we need to make that infrastructure available for the mine faster as well, right?
Okay, that makes sense. And also at Séguéla, we now have Antenna, Ancien, and Kula are actively mining. What is the next one you're planning to bring online?
We have in the pipeline Sandbird and a new deposit, Badior. No, so Badior is not in the reserves yet. So we are working to secure land access, surface access. We are working to convert those resources to reserves, and also, be able to have a view of Badior in the mine plan, and behind those, we'll have a Kingfisher, of course, coming, right? I don't expect we will be mining Kingfisher in 2025. Probably comes in 2026, 2027, right?
Okay. I'm sure that must feel good to have a pipeline of projects coming online, especially.
That's a blessing, particularly as you're expanding your deposits, right? You're expanding throughput, expanding your deposits. So, yeah, we're very excited about it. And Séguéla, I'll say, is meeting and exceeding our expectations in that regard.
Okay. And one other note on Séguéla, I heard on your conference call this morning, no more power issues, and the backup generator is in place now as well?
Yes. All those power issues, both in Côte d'Ivoire and Burkina Faso, that were an issue a quarter ago, are gone.
All right. And another one that came up, this was for Yaramoko, that I know one of the things you've talked about before is wanting to extend the life of mine there. And here we have a note, increase sustaining capital costs to accelerate next year's development at Yaramoko to access newly identified mineral resources. Anything you could share on how things are going there?
Yes, we just touched on that, first addressing Séguéla and its capital requirements into 2025. We have been successful with the exploration at this mine. When we acquired Roxgold back in 2021, Yaramoko was set for closure in 2023. Instead of closing in 2023, we had a very strong 2023. We're enjoying a very strong 2024, and we're looking forward to an even stronger 2025. Now, what that means is that we've been successful expanding resources. What does that mean? Well, we need to spend money invest in developing the mine, developing these new resources that we continue to bring. So to have a good, robust plan for Yaramoko in 2025, we are accelerating about $11 million on investments this year, in the second half of the year. So you'll see some of that in Q3 and a lot of it in Q4. It's about $11 million. Those $11 million we're investing, you will not see the reward of that in 2024 because those capital projects are basically underground development, underground infrastructure, will serve the 2025 mine plan, right? So just because of how all-in sustaining cost is estimated, it will burden our all-in sustaining cost in 2024 and will benefit from that in 2025, right?
Okay. And the other thing I wanted to, go ahead, Dave.
No, you go ahead and we can come back. Quick question.
Well, I was going to start into San Jose, but
oh, okay. Let me just get this out of the way really quickly. I just wanted to circle back to Badior.
Yes.
You haven't released a resource estimate on that. Is that going to be incorporated in the updated Séguéla?
Yes. Yes.
So, I mean, and if you're going to start incorporating it into your mine plan, I mean, it's got to be ready to go.
Still has to go through work in 2025 to incorporate it into the reserve plan.
Okay.
The idea is that it will come into, so we're spending money, we're investing in surface rights, compensation, land access. You know, we're getting all of that moving ahead. All of that takes months. So if I want to see it in the 2026 mine plan, there is, you know, I'll have a resource by the end of, before the end of this year, and then a lot of work needs to take place before we can call it a reserve, right? But it's coming into our reserves plans probably in 2026. So we need to invest money towards that in 2025.
So I'm looking at the map here. I mean, about how far is it from the processing plant?
That one is probably 7 kilometers.
7 kilometers. And when you say build access to it, does that mean you're going to have to put in a road that'll handle the mine trucks?
We have a light vehicle access. So for the large trucks, we need to, you know, build that road, just like we did with Ancien. Ancien is in the opposite direction, but probably at a similar distance. So if you're looking at that map that we provide, we had to develop the same off-road truck access. With that comes, you know, land compensation, negotiations, and whatnot. Everybody's quite friendly and receptive in the area for that. So I don't see any issues, but it's work that needs to be done in a timely manner, properly, right? So we start with that time in advance.
Okay, thanks. I had to ask about that because I didn't realize that you were getting ready to declare Badior as a deposit. So it's kind of upside surprise that you're going to add your 6th deposit to the mine property.
Yes, you should expect to see Badior in our resource inventory before the end of the year.
That's impressive.
Well, there you go. I'm glad you got your money's worth today's call there. And with that said, Jorge, obviously you also mentioned that there's the closure of San Jose. Anything you could comment on there? Perhaps the decision-making of what led to closure versus care and maintenance. And I know you outlined in the press release the steps of what's going to happen, but maybe you could just mention briefly today for people listening as well.
Yes. I'd like to take a quick second here to remind your audience that we have a particular attachment to San Jose because it's a project that we acquired early on, back in 2005, 2006. And we have advanced these projects from early stages of exploration through to development, design, financing. We built a mine which we subsequently expanded. And in 2016, this mine ranked among the top 12 primary silver producers in the world. This mine alone delivered between 7 and 8 million ounces of silver annually, plus some 50,000, 60,000 ounces of gold annually, right? It's been a pillar in our portfolio for many years. Production started back in September of 2011. So it's been operating for 13 years. And we have exhausted reserves and we're preparing to close it. So I've been communicating to investors, analysts, that we would be making the decision with respect to what we do with San Jose in the third quarter. And that's what I'm doing now, right? I'm following up with what I said. San Jose will go into closure, into a progressive closure starting in early 2025. Concurrent with the closure, we'll be conducting some mining activities at a reduced rate of under 1,000 tons per day. Remember that this mine has a production capacity, throughput capacity of 3,000 tons per day, right? So the mine will be producing at a small reduced rate, concentrating on some very focused areas of the underground mine. Operations will continue for probably 18 months, right? And they will be concurrent with some of the closure activities, particularly the initial ones with, ancillary facilities and things. So this is a multi-year closure plan. It's an 8-year plan where the bulk of activities take place in the first 3 years. And then we go into more of a monitoring phase, right? Our expectation is that the closure, the mining that takes place over the initial 18 months significantly funds closure activities in those initial years. We have in our balance sheet a provision of about $14 million for closure at this one mine. I can advance that based on the detailed work that we're doing now and updating at a feasibility level the closure project, because that's what it is. It's managed as a project. That figure is likely to increase, no? And but we're comfortable that those continued mining activities at a smaller rate, but at current prices, and with the recent devaluation of the Mexican currency, that also helps us a lot. So we believe that the mining operations can fund a significant portion of those closure costs in the initial 2 years, right? Which is where the bulk of the money is spent.
Okay. And you talked about this a little bit this morning, but what are the plans? What do you ultimately do with that asset at this point?
First we will return the land to its original state, no, according to a closure plan. So we will remove all of those buildings and things. That is what we do. Remember that this is an underground mine and we have a very small footprint on surface, right? So we will be lifting, removing, offices, warehouses, the site where the plant is, crushing station, all of that will be lifted. The infrastructure that will remain there will be the reclaimed dry stack tailings and conventional tailings facility. Everything else will largely be lifted, removed, right?
Okay. Dave, did you have any questions about San Jose?
Just rest in peace, I guess.
Rest in peace. Yeah. Sometimes one can get a bit sentimental with assets.
I actually did think about that this morning after I read about it last night. I mean, that was basically the company maker mine.
That was a company maker mine, absolutely. And we did it with very little money and facing a lot of challenges. Fortuna back then was a complete different company than what it is today, right? So today, to face a $400 million construction or whatever, we have over 5,000 people, top professionals in Fortuna, today, a diverse pool of talent. But in those days, it was a handful of guys trying to materialize a dream, right? So it was far more adventurous, I would say, than what it is today.
Now I'm getting misty-eyed.
I love the sentimentality, Dave. Jorge, two last ones before we wrap up here. You've talked the past couple of times we've been on here, especially since the financing deal you had a couple months ago, about things you were doing with your balance sheet, and you had some highlights in here. Net cash flow positive at $8 million. You also reduced the credit facility from $250 million to $150 million and increased the uncommitted accordion by $25 million to $75. Anything you'd like to touch on in terms of capital structure or anything along those lines?
Yes, capital allocation is a topical issue for us. Okay, we're making money, and what are you going to do with the money, right? So, as I've been saying, first one is fortress balance sheet. Mining companies need to put together fortress balance sheets at times like this, right? So remember that we've been building and expanding for the last years, right? So in this quarter, we have pivoted into a positive net cash position. That means that we can service all of our debts and still be cash positive, right? And we'll continue building that net positive cash position, which for a mining company is important, right? I think other industries, other companies, you can live with a high debt leverage, and you use that leverage to provide returns to your shareholders and whatnot. But you have pricing power. In this industry, we do not have pricing power, right? So we live at the expense and volatility of the commodities we sell. So managing prudently the balance sheet, the cash position, the treasury is key. And currently, our debt to EBITDA ratio is a low 0.2, and we want to keep it there. We're having now a net cash position. We pivoted this quarter into a net cash position. So we have lowered now our debt level without compromising the liquidity of the business. We still have liquidity of over $350 million, but we have restructured our facility, putting less pressure on the covenants and lowering pressure on the side of covenants, and also lowering cost. Quarter over quarter, comparing 2023 to 2024, we have lowered our financial cost by $3 million in the quarter, right? So we are working on that. That's a priority for us. We talk a lot about in our business about the exploration and the mines, but now I think the discussion around the balance sheet, the liquidity of the company, the debt leverage of the company is key. And we're very focused on that. I know that there is a lot of, I'll say, of course, interest on the part of shareholders on the discussion of returns via buybacks or dividends, and we pay a lot of attention to that with the board. It's an ongoing discussion. And even, as I say, it's not a question of if, it's a question of when for us, right? And I believe that, again, the priority is that fortress balance sheet, and we have achieved that, no? So we're going now into the next leg. And concurrent with that, of course, funding the aggressive exploration to unlock the value of our properties. And we also are doing that. So those are the two priorities, no? Strengthen the balance sheet, provide maximum financial flexibility, lower financing costs, and unlock the value of our properties. And as we just discussed, we have increased or exploration budgets. We are spending about 5% of sales on exploration, right? Close to 5% of sales on exploration. So that's like our research and development. I don't know how many companies spend that much on research and development, right? So yeah, that's what we're doing. That has been the priority this year, right?
Okay, and my final question, you touched on it a little bit. I don't know if there's anything else you'd like to add, but I know you do get a lot of people asking about the dividend. Anything further you'd like to add to what you just said there? Or?
Yes, I just to share with you, I engage with these discussions regularly with all our investors, shareholders, and I have to find that I find the answer all over the place. No, there are guys who understand the mining business from the perspective of how capital intensive the industry is. And they make reference to Warren Buffett, saying that Warren Buffett has never paid a dividend. So why should you? Then I have investors who dislike dividends and prefer buybacks any day of the week. And then I have other guys who just are focused on the dividend. And they all have a good, sensible angle to their proposition, right? And we listen to them all. But what's clear is that returns are expected, and we're here to provide returns for our shareholders, right? So,
okay, well, I appreciate you.
When or if is a question of when, right?
Okay, well, I think people will be happy to hear that. And with that said, Dave, did you have anything else that popped into mind before we wrap up here today, my friend?
Nothing else I can think of.
All righty. Well, glad you're having fun today, and it's good to see you as always. Thanks for joining us. And Jorge, congratulations on a great quarter. And I know we've said this before, but certainly, didn't just start in this past quarter, reflection of a lot of work that you guys have done as a company in the past couple of years, and really excited for you. And thanks for joining us today. And we will look forward to seeing you again soon, and Dave as well. And thank you everyone out there for watching. And with that said, we'll wrap up and see you again soon.